What's up, everybody? Sam Sharp here, and in today's video we're going to talk about both sides in the hot topic of should you put 20% down or not. Putting 20% down on a house has long been considered a standard recommendation for a few good reasons, which include avoiding private mortgage insurance, or PMI. When you put less than 20% down, most lenders require that you pay private mortgage insurance. PMI protects the lender in case you default on the loan. This expense adds to your monthly mortgage payment and can make the overall cost of the loan higher. Another item, equity and lower loan-to-value ratio. A larger down payment creates instant equity in your home and reduces the loan-to-value. You will hear this referred to as LTV. LTV is the ratio of the loan amount to the home's value. Generally, a lower LTV is seen as less risky by lenders and can lead to more favorable loan terms. Next, lower monthly mortgage payments. A larger down payment reduces the principal amount of the loan, leading to lower monthly mortgage payments overall. This can improve your monthly cash flow. Less interest paid over time with a lower loan amount due to a larger down payment is another good option. You'll pay less in interest over the life of the loan, potentially saving tens of thousands of dollars, especially now with higher interest rates. Also, consider increased likelihood of loan approval. A larger down payment can strengthen your mortgage application, making you a more attractive borrower to lenders. It demonstrates financial stability and commitment to the purchase. However, there can be situations where putting 20% down might not be the best financial strategy, such as home appreciation. If you're confident that the value of the home will appreciate significantly, a smaller down payment might make sense if you believe the potential increase in the home's value will offset the cost of PMI. Appreciation values have skyrocketed over the last few years in most areas. You can also retain liquidity. Keeping more cash on hand by making a smaller down payment can provide a financial safety net for emergencies or other expenses. Next, get free money. Look for down payment assistance programs. These are available in each state, and they can potentially cover some or all of your down payment and closing costs. There's also investment opportunities. If you have other investment opportunities with potentially higher returns, it might be more advantageous to allocate some funds there instead of tying up your resources in a larger down payment. Also, similar, the opportunity cost. If you're able to invest the money elsewhere and earn a higher return than the interest rate on your mortgage, you might consider using a smaller down payment. And last, the immediate need for a home. If you're in a situation where you need to buy a home sooner rather than later and you're struggling to save 20% down, putting a smaller down payment may help you get into the housing market sooner. Ultimately, the decision of how much to put down on a house depends on your personal financial situation, your goals, as well as your risk tolerance. Remember to consult with a financial advisor and your trusted lender to carefully evaluate the pros and cons before making a decision. Subscribe for more mortgage and real estate tips.